Welcome to Exit Like a Boss. I'm going to show you, having helped nearly 800 business owners work through a 21-step process to exit like a boss, how you can do it, what you need to know, the steps you need to take, and what's actually involved in you and your business being able to maximize value and successfully exit like a boss. Hope you enjoy it. In this episode of Exit Like a Boss, we're now moving into stage 4. Stage 4 is the exciting part. It's where we get to extract value. Now, the first part of that is actually planning for an exit event or a liquidity event. And we're going to talk about that in a couple of episodes' time. In this episode, we're going to talk about a very, very boring issue, tax, but a very important issue. In most countries, when you exit a business, that's a taxation trigger. In some companies, you may pay a percentage of the sale price as some sort of capital gains tax. You might add the sale value to your income and pay income tax. You might have some other duties and costs that you need to pay. Now, the critical thing here is, in most places, and certainly in Australia, you can minimise that through tax planning. Now, I'm not talking about something dodgy or something that you can do so that nobody knows you've sold and you keep the money in your pocket. In Australia, for example, there are things called small business capital gains tax concessions. Now, they're part of the law and they're in multiple countries. They're all called different things and they're structured differently. But in Australia, they're designed specifically to reduce the amount of tax that you pay if you sell a business. They're part of government legislation that was brought in to encourage people to build up the value of their business, sell it, and help fund your retirement. And if you did that, the government's prepared to give you some tax concessions. You still pay tax at some level, but hopefully you can reduce that tax by a fairly substantial amount. And that amount varies depending on all sorts of different circumstances. And I guess that's the key point. The first thing to understand here is do not leave this until the day you sign a contract to sell your business. Tax planning needs to be done years in advance. That's why we often talk to clients about exiting like a boss actually means you need to start early, 3 to 5 years out. And one of the things you need to think about is, what does this mean from a taxation point of view? Now, there's a couple of different levels. Firstly, you've got to understand, what are you actually selling? Are you selling a business, a goodwill, or a client list, or a database, or a professional services practice? And if you're selling that business, are you selling it as a business, or are you selling shares in a company? Is it an S Corp or a C Corp? It is a proprietary limited company in Australia. Is it something else? How does all of that work? And then we need to think about, are there some of the assets that are related to the business that you're actually keeping? And we see this a lot. I see clients all the time selling the business but keeping the shop or the office or the factory for retirement. So the business will be sold, they'll get some money for it. Hopefully the business will then continue to use the premises and pay rent or lease the premises back from the owner. Now, that's great, and it's a pretty solid strategy for funding ongoing retirement, but it's got some tax implications. So again, it's about tax planning. It's about understanding what might that transaction actually look like, what assets am I selling, what assets am I keeping, and what are the tax implications? Now, you need to do a couple of things. Firstly, we already talked about way back in episode 3 about getting a business valued. Getting an understanding of what's my business worth today and what could it be worth if we went down the track of preparing it for sale and actually going ahead with a liquidity event. What number are we talking about? Am I selling it for $1 million or 5 or 50? Obviously, that's got different tax implications as well. The second thing then is to sort out maximizing the value, go through the process, learn how to exit like a boss, make sure you get top dollars. And then go and get really good advice. And this is an area you need good advice. Go and talk to your accountant, your CPA, a tax lawyer, whoever it might be, and ask them a couple of questions. Firstly, based on the valuation, my business is worth X. If I sold it today, what would that look like in terms of taxation? What potential tax costs could that incur? And then the important question, can I do anything? Are there any rules? Are there any circumstances? Are there tax concessions where I could reduce that amount? Now, the answer will often be, yes, there are, but. And the but is, but they've got certain conditions that you need to meet. In Australia, it's a net assets test. It's a small business test. There's a couple of different criteria you need to meet. And that'll be the case in most jurisdictions. So the accountant or the lawyer is going to come back to you and say, yes, I can reduce the tax for you, but you need to meet these conditions. And typically those conditions are not going to be met in a week's time. You might need to restructure some assets. You might need to move things around. If you're going to keep the building, you might need to put that in a different entity to the business that you're actually selling. Depends on your circumstances and the location and the tax rules that you work under. The critical thing is all of that takes time. So don't wait. Certainly don't wait till you've got a contract in your hand and say to the accountant, work out the tax for me. It's too late then to do anything about it. But certainly get some advice up front. Plan the tax. Make sure you're taking the opportunity to come out with the best outcome. No one likes paying too much tax. You will probably pay some tax when you exit your business, but let's work out what that should look like, how you can minimise it, what you need to do to be able to minimise it, and make sure you take advantage of any of those tax concessions or rules that are available, especially if they're written for this exact reason, like the Australian rules are specifically written for small business owners to reduce their tax. So find out, what's the business worth? If I sold it today for that, what tax could I pay? And is there anything I could do that would reduce or minimise that tax impact? And if so, what do I need to do? What steps do I need to take? What assets do I need to move? What criteria do I need to meet to make sure I qualify? As I said, it's an important aspect. It's always going to be a tax trigger or a tax event in nearly every country in the world. If you sell your business, there'll be some kind of tax impact. Get the advice early. Find out what it looks like. Find out what you can do to benefit from any concessions. And then that all incorporates back into all of the other planning. If we need $5 million to sell our business and retire, but we find out we sell it for 6 and pay 3 in tax, we're not going to meet our $5 million goal. So don't take into account just the sale price. Take into account the net proceeds. Less any tax, less any stamp duties or fees or licenses or commissions or brokerage costs or anything else that you're going to have to know what you're going to actually walk out the door with net in your hand to fund retirement. And if the tax means that number's now too low, then you need to do something different. Maybe we need to sell the business for $7.5 million and pay the tax and walk away with 5 or whatever it might be. But don't do this late, do this early. Get the advice up front, get good advice from an experienced advisor, a CPA, attorney, tax accountant, lawyer, whatever it might be where you are that knows what they're doing, that's dealt with this before and can help you minimise the impact so you can exit like a boss.